Today, we are launching Operation Economic Outcast to foreclose every other option available to the Iranian regime. Treasury has mapped every node, every facilitator, and every network that Iran has used to smuggle oil and evade sanctions. Beginning today, the actions of Treasury and other agencies will tighten the noose and block every potential source of revenue that funds the IRGC and the evil Iranian regime.
Treasury Secretary Scott Bessent threatening economic punishment against Iran and any country doing business there, as the U.S. looks for a way out of its stalemate following 6 months of war. Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. The U.S. plan to isolate Iran depends on its willingness to hit Tehran's biggest oil buyer, China, just ahead of next month's planned summit between Presidents Trump and Xi. We unpack the impact with Zongyuan Zoe Liu of the Council of Foreign Relations. Asian chip stocks leading declines in the region today after a sell-off in their U.S. counterparts. It comes ahead of earnings from Nvidia that look set to test confidence in the AI trade. Ecaterina Bigos from BNP Paribas Asset Management will help us navigate the surging concerns of tech spending and circular financing. Plus, President Trump comes up with a new way to make H-1B visa applicants pay after a court struck down his first attempt. We'll assess the impact on India's IT and finance professionals. Our top story today, the Trump administration delivers more bark than bite as it unleashes a so-called economic D-Day against Iran. Treasury Secretary Scott Bessent issuing broad threats as he warned that any country doing business with Tehran could face U.S. sanctions. Bessent avoided mentioning China by name, even though it buys the bulk of Iranian oil exports. But Bessent insists that when it comes to U.S. sanctions, no one is untouchable.
We find that the best way to engage with countries is through quiet diplomacy, and we are level setting with every country to tell them our expectations. We know who they are, they know who they are, so when the hammer of U.S. Treasury actions falls upon them, they will have no one to blame but themselves.
Joining us now is Bloomberg East Asia government editor John Hertzkovitz and our China correspondent Min Lo. John, let's start with you. I mean, we saw Bessent targeting allies, but nothing specific.
No, exactly. What was interesting was what he didn't say. We didn't hear anything about Chinese banks, Chinese refineries. And the thing is, to get real economic pressure on Iran, you have to squeeze China. China is Iran's biggest buyer of oil exports, about 90%. It's its main economic lifeline, and it is its second biggest trading partner. In order to be actual enforcement, a bank would have to be targeted, refineries would have to be targeted. And I think what we saw from Bessent is that instead of this all-out economic assault, we got more of a warning shot. We may have some things going on behind the scenes. The backdrop of this, of course, is that we have a summit next month between Xi Jinping and Donald Trump. And I think the Treasury secretaries didn't want to stir up the waters ahead of that summit.
John, how many entities, how many countries are targeted, you think? And when Bessent talks about targeting Iranian lifelines, what are we talking about?
Yeah, I mean, what we saw from the latest thing was 60 entities. These are mostly smaller companies, some shell companies. These are not the big firms that are really responsible for the financing and the processing of Iranian oil. The U.S. has been doing this for years. I think there have been over 2,000 sanctions since Trump won on Iran. And you can keep adding these shell firms to the list, but unless you go after the main players, which are the banks that help them to financing and the larger refineries that process the oil, you're not going to see much of a change in habit or any pressure really being applied to Iran. China is the key to all of this.
John, thank you so much for that. Bloomberg East Asia government editor John Hertzkovitz. And Min, as John said, China is key to this. Now it's eyeing overcapacity tariffs of 7.5%.
That's right. This is according to what sources have been telling us. The White House have not officially confirmed this, but sources are saying that the Trump administration is preparing potentially this 7.5% additional tariffs on China under the Section 301 investigation into Chinese overcapacity. The results of that investigation could be released before President Xi travels to the United States. So this is going to increase the total tariffs up to 20%, at least the tariffs in the second term, in Trump's second term. But 20% for now appears to be still within the tolerance band for Beijing, because the two sides back in October of last year when they met in Kuala Lumpur, they had agreed on a tariff ceiling of 20%. So perhaps this might not be something that would spark any retaliatory moves from Beijing. But on the other hand, if the U.S. does open up a new front when it comes to cutting off its ties with Iran or placing sanctions on Chinese firms doing business with Iran, that is potentially something that China will retaliate against.
So far, what's been the reaction from China? And is there a sense that China's possibly talking to its companies behind the scenes?
Well, when it comes to the Iranian issue, we know that China has previously said that they view any of these unilateral sanctions from the U.S. as illegal. And back in May of this year, China has told its own companies not to comply with these U.S. sanctions. But bear in mind that most state-owned companies have been complying with those sanctions. But the private refineries, the smaller ones known as teapots, they have been the ones importing and processing Iranian oil. So, and China has previously indicated if these sanctions come through, China is going to take whatever necessary steps to protect its interests. Now, when it comes to tariffs, if it doesn't go above 20%, I think that's something that China will be okay with. But of course, there are a slew of all the other issues, right? Especially when it comes to tech export controls. There's been a slew of bans from the US side, whether you're talking about drones, robotics, routers, for example, and China has not really outlined what they will do in response to that. So perhaps some of these will be under negotiation as we look towards that summit in September.
And that's the thing, Min, that is in focus. You got to wonder about the tone and the priorities for that meeting.
Yes, there is a lot on the agenda. Obviously, the timing of this potential tariff, the 7.5% tariffs, will set the stage for negotiations. So tariffs is sort of one bucket to look at. The other is tech. Remember, we previously reported that the two sides were eyeing AI talks, but up until now, there hasn't been a lot of official information about what, how the talks will happen, under what conditions they will happen, and what exactly will be discussed. And there hasn't been any sort of broad-based agreement on that front. In fact, we have seen escalation on the tech front, right? I mentioned some of the bans earlier. China also retaliating with some of its own export controls as well when it comes to robotics. And then, of course, there's also rare earths, whether or not China will continue to delay any rare earth export controls as part of an extension of that trade truce, which is due to expire in November. Expectations are the status quo. We will continue to see a status quo. Both sides will extend that trade truce, but some of the longer standing issues, especially when it comes to tech, those are unlikely to be addressed at the summit.
Min, great reporting as always. Bloomberg's China correspondent Min Lo there. Let's get more with Zongyuan Zoe Liu, Senior Fellow for China Studies at the Council on Foreign Relations. Zoe, good to have you with us. How much of this is about Iran, or how much is about leverage over Beijing ahead of that meeting next month?
Haslinda, I'd say a lot of this has to do with Iran, and as the name of the operation economic total isolation. So the goal is, as it is stated, is to isolate the Iranian regime.
Do you think it would work?
I'd say from a pure scholarly point of view, it's always a hit and a miss in terms of the effectiveness of sanctions. But here, I'd say the real question is not about whether Beijing or the Chinese government is going to support or cooperate or not. They almost certainly would say they oppose U.S. unilateral illegal sanctions. And now the more challenging part is that none of the state-owned major financial institutions bank Iranian oil. They just do not, because they do not want to lose access to the dollar system. In other words, the existing financial ecosystem or financial infrastructure is deliberately built around or bypassing the dollar sanctions.
Zoe, on the one hand, Trump wants Iranian, or rather Chinese cooperation when it comes to containing Iran and stabilizing the energy market. At the same time, the Treasury is targeting refineries and banks. How do you square that?
I think oftentimes governments, especially the U.S. government, conduct financial sanctions because they do not want to use military actions. But in this particular case, it's almost the reverse of that. So on the one hand, I'd say this is the financial acknowledgement of military actions against the Iranian regime has not generated the desired result of the Trump administration. And then on the other hand, the Trump administration's clock is ticking specifically because of energy prices. But here on the energy prices part, I'd say on the one hand, market underestimated the resilience of oil market. And then on the other hand, here, China since March has been dramatically cutting its oil import. So from that perspective, I'd say China, in fact, has contributed to the stabilization or preventing oil prices from going further higher up.
Is there clarity, Zoe, on China's exposure to Iranian trade, oil, petrochemicals, banking, shipping? Is there clarity? Can you quantify it?
From publicly available data, for example, Chinese customs data, we basically cannot get direct information. And but what we can know is that before the war in the Gulf area involving Iran, about half of Chinese import came from the Gulf area. And Iranian oil is a very tiny part of that, somewhere between 7% to 9% in terms of China's total crude import. And on top of that, the Iranian oil is when oil market was was in a oil supply glut before the war. The Iranian oil could easily be substituted from elsewhere, for example, from Russia, from Venezuela, or from Canada. So from that point of view, the Iranian oil is not indispensable for China, and certainly is not China or the Chinese major banks or Chinese state-owned or major state-owned oil and gas companies. It's not those companies want the Iranian oil. It's really the independent, smaller teapot refiners.
What do you see China doing? Do you see China perhaps speaking to its companies behind closed doors while pushing back on the U.S.?
Haslinda, I think that's really the key issue here, right? In order for this round of expanded threat of sanctions scope to work, you really need the Chinese banks themselves conduct due diligence, as Treasury OFAC alert on April 28th. That alert compelled or warned the banks, saying that you ought to do your due diligence, making sure that you are not conducting or your subsidiaries or some of your account is not doing funny business with Iran or business shell companies related to the IRGC. But here, the complicating part is that it's unclear to what extent the Chinese banks they would be willing to do the due diligence, because on May 2nd, Minister of Commerce, Chinese Minister of Commerce, MOFCOM, issued block order, basically told every Chinese entity saying that you cannot acknowledge, cannot implement, cannot comply with U.S. sanctions targeted at the 5 independent refinery, of which including Hengli, one of the supposedly the second largest independent refiners in China. So from that point of view, this is really putting the Chinese banks in a almost impossible situation. On the one hand, you know that they are not knowingly doing business with Iran, but are they willing to go the extra mile to do due diligence of all their subsidiaries and all their funding accounts? It's hard to tell.
I also wonder whether China might use this as a test case to push back against U.S. financial dominance. So, defy Bessent just to test the ground.
I think Haslinda, China has already done it, to be honest, back in May 2nd, directly in response to back then the threat of expanding secondary sanctions to financial institutions. We basically defined it. But the verbal protest or issuing block orders is not the same as enforcement capacity. And here I'd say the new round of expansive sanctions threat. This is not necessarily sanctions immediately in effect. These are basically it's a manual of options that the Trump administration laid out. And countries are going to get deadlines in terms of compliance. So in a way, this really gives both sides some room to maneuver. And I wonder perhaps this is also built in some soft room in anticipation of President Xi Jinping's visit to the United States in September.
We know that China has been trying to de-dollarize. Might these sanctions, although they're not sanctions yet, might they meaningfully accelerate China's efforts to de-dollarize?
I'd say, Haslinda, here, de-dollarizing, this is the interesting misunderstanding, I'd say, about de-dollarization. De-dollarization as in terms of an action. So every single transaction that could have been used in dollar, but instead being used in alternative currencies, like the dinar or the yen or the Chinese yuan, renminbi, or Russian ruble, or, like any other transactions that could have been used in dollars, but instead use other currencies, those are de-dollarization in action. But this is really different from replacing the dollar as the world-dominated currency, or replacing the dollar financial system as the preferred global financial architecture. And I even would go further ahead to make the point that perhaps Chinese financial institutions and Chinese companies or Chinese central bank and even Chinese Communist Party of China, none of those entities would have the incentive or the desire to replace the dollar with renminbi. Part of the reason is because for a lot of them, the dollar system remains to be very beneficial to China. And knowing that China has over $3 trillion of foreign exchange reserve, the majority of those are still in dollar-denominated assets.
Zoe, I'm curious, what we're seeing China do to U.S. do towards China in terms of these sanctions, is that possibly a signal to other flashpoints? Taiwan, case in point.
Right. And I think, Haslinda, this is really what, when President Xi Jinping talked about the bottom line mentality, I think perhaps the collective sanction against China, a Chinese financial institution, and the entire economy, perhaps is what they have in mind. And this is exactly why they would want to build an alternative to the dollar system, so that just in case. It's a hedge against comprehensive collective dollar sanctions rather than they want to replace the dollar system with renminbi. So think about the renminbi alternative payment system as a way or as an exit from dollar sanctions.
How about perhaps, a signal when it comes to their war on advanced chips?
The war on, sorry, I didn't quite hear you clearly. You say the
semiconductors
war on,
and AI. Semiconductors,
right.
chips.
I just think. Right. That is an interesting point. And I hear colleagues in DC or in New York debate to what extent export controls remain is effective. But I'd say that debate is already a moot point, Haslinda. Part of the reason is because after 2018, not just the Communist Party of China, all Chinese entrepreneurs, the tech startups, they themselves realized that in order for them to have a space, not just in the world system, but also inside the Chinese market, they themselves realize that they cannot rely on U.S. supply alone. And basically, it's starting from 2018, there is this incentive convergence between the party and the tech startups. Everybody wants to achieve technology self-sufficiency. And what the Chinese government has been doing since 2020 is that they have been reforming the entire financial system to finance tech self-sufficiency. So from that point of view, I'd say even if China is willing to buy U.S. chips today, the goal is to not buy tomorrow.
Zoe, great stuff. Thank you so much for that. Zongyuan Zoe Liu from the Council on Foreign Relations. Plenty more ahead. Keep it here with us. This is Bloomberg.
We haven't bought a single bond yet. The next time we have an operation is September 9th.
Welcome back. That was U.S. Treasury Secretary Scott Bessent responding to questions about whether he will increase bond buybacks in the near future. Well, Asian markets are pricing in dollar weakness from the U.S. Treasury's attempt to contain bond yields with a buyback. Meanwhile, tech stocks are showing renewed volatility ahead of Nvidia's earnings. Markets reporter Anthony Stevens joins us from Hong Kong. And Anthony, run us through that reported plan to access the U.S. Treasury general account to fund bond buybacks and what's been the market reaction.
Yeah, this is a little bit of an attempt to give some legitimacy to the sizes being talked around to contain these yields, right? So the Treasury General Account has about $900 billion sitting in it. Of that, market participants estimate around $200 billion of that is available. That's according to Morgan Stanley. And that will be available without using short-term bond issuance. So there is a little bit more legitimacy there. There's a little bit more firepower. But how far can that go in containing bond yields in the long run? That is the point of debate here. It's not whether they can cap them in the short run. So that debate is feeding into two places. That is feeding into the FX market, which is the natural outlet of what is seen as a naturally easing kind of policy. So the US dollar has been selling off pretty sharply against the carry trade and emerging market FX. And also the yields really haven't gone anywhere. They're just stuck in a range. And that's drawn some criticism from across the street. You have Bessent's former mentor, Stanley Druckenmiller, calling it kind of ill-advised. We have Citadel calling it financial repression. So there is not a lot of positivity around the feasibility of this kind of initiative, but they are going to continue nonetheless.
The bond buyback is one thing. The tech trade faltering is another. And why is that tech trade faltering ahead of Nvidia earnings? And what's the market looking for next?
Yeah, Nvidia has become kind of the central bank of AI, right? And as a result, its earnings are going to be more closely watched than normal. Nvidia's CDS is getting worse by the day. So is its competitor Broadcom, as they look to finance the AI build-out as well as profit from it. Now, on the profit side of things, they had a price increase that the market saw as little too late, right? It was around 15 to 17%. That is materially less than how much memory prices and other passive components have gone up. So there's a little little bit of margin compression going on there at Nvidia, which is sitting on 75% margins at the moment. So as a result, a lot of the Nvidia suppliers are trading much weaker in Asia as they anticipate that some of these price increases have reached their logical limit. Now, going back to the yield conversation, the bar that treasuries are placing on the AI trade keeps increasing, right? If you have treasury yields at around 5%, the bar to beating that is quite high in the second half of the year. And Nvidia will really need to show some really good results, some really good guidance, and some lot of positivity and confidence to get this trade back on the road.
And the bar is very, very high. Anthony Stevens, our markets reporter, thank you so much for that. Let's bring in Ecaterina Bigos, CIO for Core Investments Asia ex-Japan at BNP Paribas Asset Management. They oversee about $2 trillion in assets globally. Ecaterina, your thoughts and on the weakness of Nvidia ahead of its earnings?
We've heard the Bloomberg representative talking about it. I think the expectations are very high, and coming into this earnings season, they've had a subsequent earnings reports that Nvidia had actually sold off, because I think the expectations on Nvidia are already so high. And now, of course, the expectations are what the market is going to look at is understanding if there is more leg to run with regards to this AI trade. But what is it looking at is diversification of their own cash flows from hyperscalers to other companies. They're going to look at the new technology coming in and what is the timeline for that. They're going to look at the circular financing and understanding if that is not creating or catalyzing cash flows into Nvidia. So I think the report is going to be scrutinized, and there's a lot of parameters to account for. Hence, the market is coming in a cautious manner.
So you got to wonder whether we could see a turnaround. I mean, how might the markets read all those numbers? What's your take on it, especially on the back of 7, 8 consecutive days of weakness for the stock?
We need to revert a little bit to the fundamental picture. We are almost at the end of the earnings season, and if you look at the earnings season, the strength is again one of to none. We've had 50% beats in terms of the EPS for S&P 500 and expectations around 22, 23. And then if you look at the strength of it is broadened across sectors. So with the exception of healthcare, by and large, all the other sector has beat expectations, but also 8 out of 11 sectors actually have double digits earnings growth, which is incredibly resilient earnings. And what is happening at the moment, despite that resilience, the market is not taking that positively because of a confluence of different factors. And also not to forget that we also still in a summer month where liquidity is quite limited. Most of the traders have not come back yet to their desks. So it's a confluence of different factors that is putting pressure on that kind of reading that fundamental picture, which is very resilient. And as I said, not just resilient, but also broad, which is bringing a resilience and diversification to even U.S. economy in terms of the growth trajectory.
You talk about the resilience, yet, when it comes to the chip stocks, they're in bear territory. That fallout started in July. So the bad news is overdone. The sell-off is overdone.
Absolutely. And if you look at what the catalyst for that has been, certainly the capex or the amount of capital that hyperscalers are spending on AI story has been one of the catalysts, but not just the capex, but the questions around, is this capex being monetized? And we've seen through the earnings season, it started more or less with kind of releases from Google when the Google has announced that they're going to increase the capital expenditure, but also through the earnings season, I've seen companies like Microsoft reporting stronger earnings from the AI story. We've also seen, again, not a public company, but Anthropic has said that their AI revenues have increased. Then market started to revise and obviously bring more confidence to the ability of this AI story to monetize that capital expenditure. But also not to forget what has happened during the summer month. We had obviously a significant deleveraging that was materializing. One, because Bank of Japan has moved to hike rates, and that has led to kind of that funding trade being unwind. We had significant leverage in places like Korea, and some of the even retail investors, but institutional investors had to de-risk their positions, which has catalyzed, again, a sell-off that was structurally, again, fundamentally was decoupled from where the fundamentals were. So, again, a more structurally driven because of some elements that were materializing through the summer.
So where are the opportunities given the disconnect between how the stocks are trading and the fundamentals?
I think the opportunity is there, and I think at the moment markets are not paying attention to the fundamentals. They're distracted by the headlines that we're seeing. They're important headlines, without a doubt. Obviously the funding costs are being elevated, and as we know, 10-year treasuries being above 5% is not conducive for growth, particularly for the small to mid-cap companies. And that is obviously the market is trying to digest, obviously, strong fundamentals, but a confluence of factors that are obviously could detract from that strong story that's unfolding. But as market, and I think that's what the Treasury Secretary is looking to do, is stabilize the Treasury market to give the market the ability to digest the fundamental story in a much more kind of coherent way.
Are you concerned about where yields are or yields have been?
There's an element of volatility. I would say concern is probably not yet. Again, the volatility is present, but there's again the what is materialized. Obviously, as I said, started during the summer of the unwinding trade of the AI trade, which has happened. Some of the Treasury obviously was one of the most liquid assets that was sold off. So obviously, the selling off started because of the unwinding of the AI trade. Then, of course, the concern around the capital expenditure, the borrowing that's happening from the hyperscalers have again added an additional concern, and then again, the ballooning of the debt for the U.S. has created an additional catalyst for that. And not to forget the extension of the Iran war. It's another element that is certainly concerning investors. And what the Treasury Secretary is doing and the U.S. administration is trying to hit from all parts to stabilize or to come to a resolution to the Iran war, to cool off the market with regards to inflation expectations, and certainly creating some level of the buyback to kind of bring some level of stability to the Treasury yields at the moment, which slightly that decoupled because, again, the level of shorts on Treasuries is above the historical average that we're seeing. So, again, certainly the market is positioning the other way, which is structurally pressing Treasury yields.
It is interesting because we heard from Bessent saying how the yields are not reflecting fundamentals, and some in the market have also said about how, we're seeing mispricings in the long end and there's room for a rally going forward. How do you position for that?
I think there is a scope for that, but you have to understand that you need to capitalize for that or, account for the volatility. The volatility will be present. Again, we have the Jackson Hole coming on this Friday. We're going to have CPI data. We're going to have numbers around payrolls. Around all of these data points, we're going to see volatility because, again, the market is at a crossroads where, again, there's not conclusive where the Fed is going to go, where the direction of travel is. But, again, the labor market is sending mixed signals, but at the same time, we have this Iran war that is not coming to resolution. The oil prices are very volatile. So as much as there's an element to think that there is a decoupling from that fundamental picture, there is spurs of volatility. And again, for a long-only manager, I think we need to be cognizant of that volatility. We're advising clients to stay a little bit more shorter duration, to harness the yield without that volatility risk. But of course, you have market participants like hedge funds that are positioning themselves to capture that volatility and hence leading to some of that kind of destabilization from fundamental picture that we're seeing.
And, of course, all eyes on Jackson Hole. What kind of messaging can we expect from Chairman Walsh? Realistically, can he allay those concerns?
He could. I think ultimately it's the messaging that the market participants are going to look for. Again, the message has been hawkish, but in actions, they have not acted in a hawkish manner. He's very data dependent and he's very constructive. He's a technocrat. He's looking at what is the data telling me before I'm going to react. And I think some indications that he has sufficient data, or he has sufficient steam that is digesting the data in an eloquent way to give him direction and give markets some level of direction to where this is going to land by the year end, I think will be incredibly important. So it's a critical meeting, particularly where we are in this market volatility that's materializing at the moment. I think Jackson Hole will be very closely watched.
Ekaterina, a lot of conversation about that dollar debasement trade. Where do you stand on that, and how do you best capitalize on it?
There is obviously a risk at the moment, and it's materializing live, as you say. The long-term story, I think ultimately for the U.S., if I look at the fundamental picture, and I think this is what is important for portfolios, is, a weaker dollar is not necessarily a bad thing for the U.S. economy, particularly that U.S. is aiming to become a lot more industrial, is becoming a lot more manufacturing-driven. So certainly reshoring some of the manufacturing home, U.S. has to stay competitive. And current administration has aimed to kind of weaken the dollar whatever that is, again, a consequence of what they're aiming to do, or it's a effect of the causality that are happening at the moment. But ultimately, again, a weaker dollar is constructive for the aim of the U.S. economy to reindustrialize. So it's not necessarily fundamentally is not a negative thing. But again, we need to look at in aggregate what is driving that weakness in the dollar. So again, some alleviation of that volatility in the rate space is critical to kind of have the fundamental picture revert to normal.
And finally, before we let you go, what are your conviction calls?
We stay constructive on this AI and tech story. It's ultimately a structural story, and you're seeing the amount of capital that's going to deploy in the sphere. It's not just from private capital, hyperscalers in the U.S. We've seen Alibaba rising capital to deploy. Again, we have governments like Japan, we have Korea, obviously supporting the initiatives from their own conglomerates. So it's an immense amount of capital that's getting deployed in the sphere. Some of it is levered, and I think that's a consideration. But as soon as we're starting to see a monetization of that AI capital expenditure, clearly the market will take this in a more positive manner. So structurally, a very supportive theme. Then as a consequence of that, and I think this is critical, what I said about U.S. economy, is the broadening of the U.S. economy into real industries. What is happening as a consequence of this build-out of AI capital expenditure, and not to forget that U.S. has about 4,400 data centers. What is happening, building those data centers, is lifting the real industries in the U.S., is bringing manufacturing home. And what is happening is U.S. is going to become a lot more diversified with regards to its sources of growth, a more resilient economy. And ultimately, capitalizing on that broadening of the U.S. Story is critical. And then, of course, we have strategic stories that are unfolding in places like Europe around strategic autonomy and deployment of capital in places like defense, cybersecurity, and technology. So these structural themes is what we advise clients to look for. There is volatility, but look underneath and understand what are the structural drivers of growth and capitalize on it, because, again, this is going to lift you in 2027.
Ecaterina, thank you so much for that. Ecaterina Bigos, CIO for Core Investments Asia ex-Japan at BNP Paribas Asset Management. Well, we're counting down to the India Open. Here's a look at how they are set to open at the get-go. Let's take a look at the initial numbers. Of course, Indian stocks have been under pressure for 2 weeks now. It is likely to open in negative territory. The Sensex pointing to a lower open, down by 0.1%. In terms of the Indian rupee, 95.73.50 is that level we're looking at. Pretty stable versus the USD, and we know the RBI has been selling dollars in the FX market to support the rupee, and that's according to traders. And meantime, Indian traders are preparing for their first monthly derivatives expiry using auction-based end-of-day stock prices. Is a mechanism that has faced backlash over sharp swings and allegations of manipulation. Bloomberg Savio Shetty joins us for more from Mumbai. And Savio, why is today's expiry an important test for the new system?
Good morning, Haslinda. Thank you so much for having me. So it's whatever we've had till now have been weekly expiries, and on weekly expiries you only have the Nifty 50 index that only those options that expire. But today we'll have all the options. So this is stock futures, stock options, all of them expiring. We are a little, the markets are a bit worried because there is a lot of volume that will come in. To give an example, the closing auction has seen around 12 billion rupees of volume. We'll have many more times happening today. So it's a good test for one, for where prices might go, and two, whether the market can take this kind of volatility and, more importantly, volume.
So a big task. And in terms of the biggest risk to the market, what would that be?
I think the biggest risk or the biggest pocket that traders and everyone will be looking at would be stock options. Stock options in general, you have a fair sense in the last 30 minutes whether they are going to expire worthless or whether they are going to expire with some premium. We have had a couple of cases in the previous expiries, especially on the Sensex, where the Sensex was approaching an out of the money and out of nowhere it had premium. So I think that that would be the fear, a stock which appears to, or the option on the stock which appears to be worthless, and suddenly it is, it has premium. It is important here because India has moved away from derivatives that are cash settled to complete physical delivery settlement. So if you end up with an option that has premium, you would essentially have to either give money or give money or shares. So this is an important test in that sense, and I think if markets are looking at whether we would have any kind of dislocations in that area.
So, Savio, what happens if the expiry passes without any event, unscathed?
Oh, no event will be a great event today from I think everyone's perspective. I think if this goes relatively unscathed, I think it would be a thumbs up for SEBI, the regulator, traders, etc. Because we have, I would kind of chronicle this as the semi-final today. The final is probably on August 31st, where you would have the MSCI rebalancing that would probably hit. So if we do well today, I think we are set up well for final. But if we don't do well today, then I think there are questions to be answered.
And we shall know soon enough. Savio, thank you. Savio Shetty,
Absolutely.
India Equities Option reporter there. We're also keeping an eye on India's IT stocks after the Trump administration revealed plans for a hefty new fee on visas for some highly skilled foreign workers. A federal court struck down its previous plan back in June. This time, the administration is trying to advance it through a regulatory process. Companies would have to pay roughly $103,000 for each candidate they sponsor for a visa under the H-1B program for foreign-born professionals. Unlike the earlier initiative, it would apply to almost anyone getting a new visa, not just those who are outside the country. For more, let's go to New Delhi and Bloomberg Shruti Srivastava. And Shruti, tell us more about how this can impact workers and students.
Thanks, Haslinda. So yes, right now we don't know whether this will pass the muster or not. But yes, the initial commentary is that Indian outsourcing firms definitely use the H-1B program heavily for their work in the U.S. Indian students they go up to the U.S. for study, and typically Indian students essentially get temporary work visa and then long-term residency in the U.S. Through this H-1B program. We should keep in mind that Indians make up almost 70% of the visas which are issued by the US. So definitely this is likely to have some impact on the students who are looking to study in the US, and work there. For Indian companies, we should keep in mind that they have been preparing for it for some time now, and they have been maintaining consistently that this is not going to impact their operations much. But we have to also keep in mind that India's $280 billion tech service industry is a big one, and services exports are one of the key exports from India. So there are various threats to it, and we'll have to keep an eye on all the developments which happen.
The amount is so huge, it is onerous. Might this affect ongoing India-US trade talks?
Absolutely, the amount is onerous, and we don't know how exactly will it impact the India-US trade talks, but I would say it is yet another hurdle which has been posed by the Trump administration. The two sides, they concluded their trade deal, the first tranche of their trade deal in February this year, but they have yet to sign it. This is because there have been several tariff steps which have been taken by the US, and India has long maintained that once those tariffs, for example, Section 301, they are taken care of, till then it is very difficult for India to sign a deal with the US. Now with this H-1B visa fee, I think this is yet another hurdle in those trade talks and for the trade deal to be finalized.
Welcome back. You're watching Insight, and here are some of the stories we're following. Porsche has signed a $1.5 billion partnership with Tata Consultancy Services to expand the use of AI across its business. The Indian software company will also acquire Porsche's consulting unit for around $370 million as the automaker looks to focus on its core business. TCS says the partnership will give it a stronger foothold in Europe. Elon Musk says SpaceX plans plans to launch its first AI satellites equipped with Nvidia chips in the fourth quarter of next year. In a post on X, Musk says the orbital data centers will hit significant scale in 2028. SpaceX pinned its blockbuster IPO in June on pioneering space-based data centers as a lower-cost and more environmentally friendly alternative to land-based facilities. And PDD shares closed lower in New York after the Temu owner's second quarter sales missed estimates. Revenue grew 8% from a year ago to $16.6 billion, but adjusted earnings of 19.33 yuan per US share comfortably beat projections. PDD is facing global regulatory pressure, including over the quality of goods available on Temu. And before we go, here's a look at tomorrow's show. Thai Stock Exchange president will be joining us to discuss initiatives aimed at attracting high-quality tech listings, and HSBC's global chief economist will be sharing her outlook amid elevated energy prices and inflation risks. That is it for Insight. This is Bloomberg.